So up until about 40 years ago, people could invest in real estate and take the passive losses and help offset their active income. This was a real popular strategy for high W-2 earners as well as successful business owners. They could just go buy a rental property, and after it's depreciated and the expenses are taken out, it would generate a loss on paper that they could use to help lower their active income, which would help lower their taxes. Well, in 1986, Congress disallowed this, and there are still some ways to help use your losses from real estate to help offset your income. And on the part one, I want to talk to you about how to do that if you own long-term rentals. So on long-term rentals, you can qualify as what's known as a real estate professional. Now, you don't have to be a realtor in order to do this, although it does make it easier because you're already actively involved in that type of business. But if you're not, you still have to, either way, you still have to meet a 750-hour test where for 750 hours during the year, you are working in that real estate business, and more than 50% of your time is engaged in this business. So if you're a W-2 employee or a business owner that's not involved in real estate, you have to work more than half of your time in the real estate business to count the losses. So for example, if you work 1,000 hours in your day job, you have to work 1,001 hours in your real estate business. So that can kind of make it pretty difficult if you have a W-2 job or own a business that's not involved in real estate. In addition to those two tests, you have to meet 1 out of 7 material participation tests. So you do have to be actively involved in the business. I don't have time to talk about the 7 tests, but you need to meet 1 out of the 7, in addition to the 750 hours and spending more than half of your time involved in the business. If you have any questions, feel free to reach out. I know it's kind of complicated. Be glad to talk to you. Thanks for watching. Have a good day.